In this test review, I will be discussing the following topics, and the most dominant topics will be cost behavior. Okay, so at the end of this test review, my objectives is that you'll be able to find cost method, be able to find fixed cost, variable cost, cost of goods sold, and also break-even point. Okay, there are several ways to do accounting, and whatever way you choose, keep practicing, and good luck on your test. We have a couple of problems here that I will take you through. The first one is this one, okay, where we have been asked to find the cost method using, or the cost behavior using what we called high-low method, okay? And high-low method gives us our variable cost and our fixed components, okay? And we have this month here. How many months do we have here? Oh, this month here, what we're going to use to calculate. And we have the machine hours here, and we have the cost here, okay? So I'm going to take you through a moment how to find the cost high-low method, okay? So I have my own notes that I have done here. So when we're doing high-low method, okay, we have the high divided by the low. Okay. So here we are trying to find y, and y is a plus bx. A is the fixed cost, b is the variable cost, and x is the amount of activities. Okay. That's what we're trying to find. But we need to start with finding our variable cost. We need to start with finding b. So the first step you will want to do is to find b. What is b? Okay, and the b is the change in cost divided by the change in activity. And I've made it simple so you can follow. Okay, the arrow point to change in cost is change at the highest cost, at the highest activity, minus cost at the lowest activity. Okay, so cost at the highest cost minus cost at the lowest activity. Okay, now we're going to look for the highest activity and then also the lowest activity, because we need these two months to compute the rest of our exercises in this practice exercise 57, 56. Okay, so let's go and look for the highest activity. Okay, when you look here, which one is the highest activity? That is, the highest activity happened in September. That's 3,800. Okay, so we have 3,800 as the highest activity. And what is the cost corresponding to highest activity? That's 35,694. That's the highest cost. Okay, now let's look for the lowest activity, and that is 3,700. Okay, so the lowest activity is 3,700, and then the cost is 35,044. Okay, so I've used green for the highest activity, and I use red for the lowest activity. So let's go ahead and compute that. So the change in cost, so we need to find the change in cost, which is the cost at the highest activity minus the cost at the lowest activity. Okay, so for time's sake, for us to not spend too much time on this, I have already put in the formatting. So be easy. Okay, so what is the cost at the highest activity? So we know the cost at the highest activity 35,694. 35,694. Okay, so we have 35,694, and the cost at the highest activity. Okay, what is the cost at the lowest activity? That is 35,044. So we subtract the cost at the lowest activity from the cost at the highest activity. So we have this right there. So that is our change in cost. Okay, good. Now that we have our change in cost, we need to find our change in activity. How do we find our change in activity? That's the highest activity minus the lowest activity. Okay, the change in cost is calculated by taking the highest activity minus the lowest activity. Okay, so let's go ahead and look for our information here. Okay, now what is the highest activity? We already have it here. The highest activity is 3,800. So we have our 3,800. What is our lowest activity? That's the one in red, 3,701. Of 3,701. Okay, so we subtract that. Okay, we subtract the lowest from the highest. Okay, so we have our 99 units. Okay, so now that we have that, we are going to find B, that is our variable cost. And the whole thing every year is changing cost divided by changing activity. This is our change in cost. We're going to divide that by change in activity. Okay, so we go ahead and do that. This divided by that gives us 6.57. Okay, and remember, if when you use Excel, Excel doesn't Excel keep running it. Okay, so it keeps going. Okay, so 6.57 is our variable cost. Okay, so that is our B. We have our B. So now that we have our B, we're going to find our A, and then our X doesn't matter. That is whatever number the company number of activities that the company go through. Okay, so now we have this. Step 2 is we're going to find our fixed cost. Okay, that's the method you use to find our fixed cost. There are two ways that you can do it. You take the cost at the highest activity and you subtract BX. Okay, and if you take the cost at the highest activity, your X should be the number of highest activity. Okay, if you take the cost at the lowest activity minus BX, because you use lowest activity, the X should be the activity at the lowest level. I'm going to do these two and then we compare them and you see how this two works. Okay, so what is the cost at the highest activity? The cost at the highest activity, we have it here, 35,694. So 35,694, that's the cost at the highest activity. Okay, now minus BX. Okay, what is our B? This now has become our B. Okay, this is our B now. So 6.57 multiplied by the highest activity. Okay, so 6.57 multiplied by what is the highest activity, the number of activity at the highest level, 3,800. So multiply by that by 3,800. Okay, that gives us this. So we subtract the BX from the cost at the highest activity. So this will be this minus that. So we have 10,744.51. Okay. How about we use the other way I'm talking about? If we use the cost at the lowest activity. Once we use the cost at the lowest activity, our number of activities should also be the lowest at the lowest level. Okay. So what is the cost at the lowest activity? Let's go back. The cost at the lowest activity 35,044. So we put 35,044 right here. Now I have to find BX. Okay. We know the B, this is where B, but our X this time will come from the lowest activity level, okay, which is the number of activities at the lowest level. When we did this, we used the number of activity at the highest level. And because we use the cost at the lowest level, the number of activities should come from the lowest level. So let's do that. So this is our B multiplied by what is the number of activity at the lowest level is 3701 in red, okay? So 3701. And you can see the number should be the same because we have the same numbers here. Okay, we have the same numbers. It works so perfectly. And then we take this and we subtract the BX from it, and we still have 10,744. So you can use the cost at the highest activity, or you can use the cost at the lowest activity. But remember, if you use the cost at the highest activity, the number of activities should come from the highest level. If you use the cost at the lowest activity, the number of activities should come from the lowest level. Okay, I made this note so simple so you can understand. And now you find your Y, fixed cost plus variable element. So BX is the variable element. So when they ask, what is the total electrical cost? Okay, it's Y equal to fixed cost plus variable element, which is A plus BH. And what is our A? We know our A to be 10,744.51. That is our A, okay? Plus, what is our B? 6.57, okay? And what is our X? We don't know. The X is every machine, every 1 hour, every one machine hour, the variable cost is 6.57. So that's why we're going to multiply by it. Okay. So this is the cost formula: 10,744.51 plus 6.57x. So that is your cost formula. Okay. That's your cost formula for this exercise. Okay. I hope that makes sense. Great. Awesome. Now that we have that, let's go ahead. Let's move on. So you can take note of this steps. Okay, you start with step 1, you find B, and then you find A. Okay. Let's move on to practice 100. Okay. So we have an exercise here. We have the information here that we need to find, just like we did with the previous one. Okay. There are a bunch of information here, but I've already read this one, so I know what I'm looking at. But you can feel free and pause the video and read it and see if you can find what the exercise is asking you to do. Okay. Basically, you can see in the first hand that you need to find net operating income. So this looks like an income statement that you have to do. Okay. It wasn't specific whether you should use contribution format or traditional format. So you choose for yourself which one you want to use. Okay, doesn't matter. So, but here we are trying to find a couple of things here. Okay. So this means to find my net income, I need my sales. Okay. I need my sales. I have my sales here. So these are my sales, 270,000. I need my expenses. Okay. I can see here I have selling expense and I have administrative expense. Okay. Those expenses are things we need. But what is my cost of goods sold? Because it's a manufacturing product, I need my cost of goods sold. I don't have it. It hasn't been given me. That is what we are going to compute, our cost of goods sold. So we can find our gross margin or our contribution margin. Okay. So that's all you have to do in order to find your net operating income. You need your cost of goods sold. So I'm going to reveal the formatting so we can go ahead and do those. Okay, great. So first one, you need to begin with your beginning raw materials. Okay, so what is our beginning raw materials here? Can we find it, or can you find it? It says beginning. So we look for the word beginning, and raw materials account was 33,000. Okay, so that means our beginning will be 33,000. Okay. Did we purchase anything else? Okay, we purchased the raw materials. So it says purchase here. That's the key point. Accounting 62,000. So we purchased raw materials for 62,000. So we add those two together to give us 95,000. So those are raw materials available. So we already had 33,000 and we purchased 62,000 more. So now we had 95,000 of raw materials to use. Those are available. Okay. And the next one is you subtract the ending raw materials from it. Okay. Subtract the ending raw materials. So what is our ending raw materials? Let's see here. Okay, it says raw materials inventory account was. Okay, so was means that was the ending. Okay, 30,000. Okay, materials was 30,000. So we're going to subtract it. That becomes a minus. Okay, and then we add those two together. Okay, so let's see. We only need to add these two. Okay, and we have 65,000. Okay, now indirect raw materials. Okay, I put this here so you can see when you have a problem that doesn't have indirect material. In this case, there's no indirect material in this problem. You can read through. There's no indirect material. Okay, if there were to be indirect material, that's when you put the number there and you subtract. But there's no indirect material, so it's 0 here. Okay, is 0 here. And if we subtract this and subtract the 0, we still have 65,000. Okay. Now, now that we have our raw materials, okay, we need our direct labor and we need the manufacturing overhead. Great. So what is our direct labor here that we need to look for? Okay, so let's look for direct labor. Okay, so it says here, right here, the keyword direct labor here cost was 46,000. Okay, so we put 46,000 here. Okay, and then what is our manufacturing overhead? Okay, we need to do the same thing. Manufacturing overhead was 74,000. Okay, so we put 74,000 here. Okay, and we add those three together. Okay, to give us our total manufacturing cost. Okay, we add those three together, and our total manufacturing cost is 185. This will surely appear in your text. Okay, so remember, you know how to do it, and they are different between manufacturing cost and cost of good manufactured. Okay, if you were only asked to do cost of good total manufacturing cost, once you get here, you stop. Okay, you don't go any further, and then that will be your answer. But in this case, you need to find a cost of goods manufactured and then the cost of goods sold as well. So our cost of goods manufactured will add the beginning and beginning work in process. Okay, beginning work in process or beginning work in progress. So what is our beginning work in process? Can you see it right here? It says here work in process was 13,000. Okay, so we add the 13,000 here. Okay, and then the total gives us this plus that. Okay, we have 198,000. Now what we have to do is subtract the ending work in process. So what is our ending work in process? Where is it? Ending work. So it says here ending balance was 19,000. So that's our ending work in process. It's going to be minus. Okay, so we subtract the 8 and then we add these two together. Okay, that gives us 179,000. So cost of goods manufactured was 179,000. Okay, great. Now that we have that, we need our cost of goods sold. Okay, the goods that we have sold, how much did it cost the company to manufacture those goods that are sold? Okay, so that's what we're going to try to find because it's a variable cost. So we know how to do with the net operating income. Okay, so now we have our cost of goods sold for the month. That's what we're going to do. But that one, you need to begin with beginning goods in inventory. Okay, so what is our beginning goods in inventory? So it says here, goods inventory account was 54,000. So we know that is 54,000. Okay, 54,000. Now, what is our cost of goods manufactured? We already have it here, so we don't need to look for it. Okay, so the cost of goods manufactured is this one, 179. Okay, once we have our 179, what else do we need to do? We need to add those two together. Okay, we add this plus that. Okay, and then we have 233,000. Okay, so that is cost of goods available. That should rather come down here. Cost of goods available for sale. So we add these two together, and then we have our cost of goods available for sale. Let me move this here so it will be easy to see. Yep, great. So we have those two, and then we have a cost of goods available. So that is 233,000. Now we're going to subtract the ending goods inventory from it. Okay, we're going to subtract the ending goods inventory. What is our ending goods inventory? So let's look for it here. Let me draw the cursor. Okay, ending goods inventory, ending balance was 50,000. So we're going to subtract that. Okay, and we add those two together. Okay, that gives us 183. So our cost of goods sold is 183,000. Okay, so I have asked a few questions here to ask. So we know the formatting in your book, you have under applied and over applied. In this case, we don't have any under applied and over applied here. So when you get here, you stopped. Okay, if there's no under apply or over apply, you stop here. There's nothing you put here. You don't have to adjust the cost of goods sold if there's no under apply or over apply. You only need to do that if there's under applied or over applied. Okay, so here you stop. That is your cost of goods sold, 183,000. Now that we are going to do what we were actually asked to do, and as our net operating income. Okay, so this is the income statement that we're going to do, and this is the company that we have right here. Okay, so let's see what we're going to do. How much is our sales? Okay, we have our sales here already started by total sales 270,000. So our sales is 270,000. Okay, what is our cost of goods sold? We already have it here, right here, 180,000. Okay, so that brings us to the total of our gross margin. So this minus that, okay, minus that, that gives us 87,000. That is our gross margin. Or you can choose to name it contribution margin. It's up to you. Okay, you can choose to name it contribution margin because cost of goods sold is a variable cost. In this case, when you use contribution margin, it qualifies to be a contribution margin. Okay, good. Now, what do we have to find again? We have to find the selling expense and administrative expense, and then subtract this from the gross margin or contribution margin. So, what is our administrative expense? We have it right here, 49,000. What's our selling expense? We have it here, 18,000. Okay. So the total will be this plus that. That's the total cost. Okay. So that's an administrative cost. So we subtract it from the gross margin or the contribution margin, who gives us 20,000. Okay, so what is the answer here? The answer is A, 20,000. So it looks simple, but you have to go quite a lot of process in order to get your 20,000. Okay, so that is how you find cost of goods sold using the schedule. Okay, you need to memorize the schedule. You need to be familiar. You need to know how things work. The only thing you need to pay attention is here. When you talk about total manufacturing cost, a total manufacturing cost is equal to direct material, direct labor, and manufacturing overhead. Okay, and in order to find your direct material, you need the beginning direct material plus the purchases. Okay, and if there's any indirect material, you subtract it from it. That's the only way. Okay, you don't even need to memorize this when it comes to the back. If you learn better by memorizing, go ahead and memorize. That, like I said in the beginning, there are several ways of doing it, and whatever way you choose, keep practicing. Okay, we have 6 points, exercise 6.2 right here. And we need to find what we have been given here. That says, so these are number one, number 2, number 3, okay, and then we have number 4 here. Okay, so number 1, we need to find what we call break even. Okay, we need to find break even point, and it says in units and in dollars. Okay, so let's go ahead and do that, and I'm going to reveal my formulas here. Okay, so break even, when we talk about break even, okay, break even is how much sales will give us a profit of 0. That means whatever we sell, we need to be able to take care of our variable expenses and then take care of our fixed expenses, and our profit will be 0. That means your contribution margin should always be equal to your fixed expenses or your fixed cost when it comes to break even. So once your contribution margin is equal to your fixed expenses, you are at a break even point. Okay, so let's look for break even. So that's why we use fixed expenses divided by unit contribution margin, and this is used for finding in unit. Okay, there are 2 formulas. So what is our fixed expenses? We have our fixed expenses here as 200 and, okay, right here, okay, 216,000. So let's go ahead and put it there, 216,000. Okay, so what is our units contribution margin? Okay, so what we do is unit CM. Okay, what's our unit contribution margin? Let's go back here, and that one is $18 right here. Okay, so we just put that number there, $18. Okay, and then what we will do is we will divide 216 by $18. Okay, so what we have 12,000 units. So the company has to sell 12,000 units in order to have a profit of 0. Okay, and as I said, your contribution margin should be equal to your fixed cost. So let's try this and see if it's equal to fixed. So this multiplied by that. That gives us 216,000. Okay, so that will be our contribution margin. Okay, is it equal to the fixed cost? Yes, it's equal to fixed cost. Okay, so that means that is the unit that we need to sell to get a break-even point. Okay, let's move ahead and find the one in dollars. So it's the same formula or similar formula, but what we do here is we divide it by unit CM, divided by unit CM ratio. That's the percentage. Okay. So we still need to use the same fixed cost, okay, fixed expense, and we already have it here. So I'm going to just reference it 216,000. But what is the unit CM ratio? The ratio is how much percentage of contribution margin out of sales, that is out of 30. Okay. So how much of this one out of that one over there? Okay, so we're using these two numbers. Okay, that's the percentage of 18 out of 30. Okay, so that's what we're going to use here. So to find the rate, we would need to find 18 divided by 30, and that gives us 60%. 60% now. And then we're going to divide 216 by 60%. That gives us 360,000. Okay. So we need to sell 360,000 units, okay? And now you're going to find what is the contribution margin for this, okay? If you want to see if it's going to be equal to fixed expenses, this is how you do it, okay? So what you will need to do is to take 60% out of the total sales. Okay, that gives you 216,000. That means if we sell at this, our contribution margin will be 216,000, and that will pay for our fixed expenses, and we have a profit of 0. Great. Okay. And the shortcut, how you can do it, you just multiply the break-even point by the selling price. Okay, if you want to find this, okay, and you don't want to divide it by whatever. Okay, so all you need to do, you take this one, multiply by the selling. Okay. What is our selling price? Our selling price is $30 right here. So you multiply by $30, and that gives you 360,000. So there are several ways that you can use to do it, and whatever way works for you, keep practicing, and you will get better at this. Okay. So let's move on to the second one. What is our number 2? Okay. Without resorting to computation, what is the total contribution margin at the break-even point? Oh, I've already explained this. Okay. To have a break-even, your contribution margin should be equal to your fixed expenses. So in this case, our fixed expense is 216,000. So even without thinking about it, our contribution margin is 216,000. It has to be 216,000 in order to have a break-even point. Okay, so that is how you need to answer it. Contribution margin is equal to fixed expense and break-even point. Therefore, 216,000. We don't even have to think. We don't have to think. Let's move on and go to the next one. Okay. So number 3, what do we need to find? How many would you have sold not to earn a target profit of 90,000? Ooh, okay. Okay. So let's pretend, okay. Let's pretend I do something. We need to target profit of 90,000. So when we did our break even, we want our profit to be 0. In this case, target profit, we want our profit to be 90,000. So in simply, what it wants you to tell is your break-even point plus 90,000. That's a target profit. Simple. Break-even point is 0. So if we need 90,000, then it means we have a break-even point plus our 90,000. Simple. Okay. So let's move ahead and find review these bad boys. Okay. Good. Now, target profit. So target profit 90,000. Use a method to verify target sales level. Okay. And this is our target profit. Target profit in unit sales is fixed. So target profit plus fixed expense divided by unit CM. Okay. So what is our target profit we want to have here? We want to have 90,000. So you put the 90,000 right here. And what is our fixed expense? Remember, you are adding it. Okay, you are adding your fixed expense. Your fixed expense, we have been using it here, 216,000. Okay, so you add those two together. Like that, you have 316,000. Okay. What is your unit CM? We already have it here. Unit CM is $18. So you take your $18. Okay. So now you're going to divide the total of the target profit plus fixed expense by unit CM. Okay. So this 2 divided by that. Okay, and that is the total right here. So you take this divided by this, and that gives you 17,000 units. Okay. So in order to have a profit of 90,000, you need to sell 17,000 units to give you the profit of 90,000. Great. And if you want to, what do you call it? I have a shortcut here that I want to let you know. So if you want, you can, because we know our target profit is our break-even plus our target profit. Because break-even is 0. So our target profit 90,000 will be added up to give us what do we call the break-even, the target profit of 90,000. So you just take your break-even point. What is your break-even unit? That is 1,200 units. Okay, you take that. And now you need to find the unit profit for 90,000. Okay, so you take 90,000 divided by 18. That gives you 5,000. Okay, and you add these two together, and you have the same 17,000 units. Great. So there's a way you can do it without going through all this formula. Okay, as I said, there are a few ways of doing, accounting. Okay, so you choose whichever works best for you. Okay, and let's go to the number 4. What do we need? What are we asked to do here? We are going to compute what we call margin of safety. Okay, this is margin of safety. Margin of safety is the level of sales above break-even point. Okay, and we know our break-even point is 0, and anything below break-even point is a loss. So if we sell anything below the break-even point, we'll have a net loss, but break-even is 0. So margin of safety, how safe are we from having a loss? How far are we? Are we close or are we far? Okay, so that's what we're going to compute, the level of sales above the break-even point. Okay, so we have both dollar sales. We need to calculate in both dollar sales and percentage, and we have 2 formulas for all those two. Okay, so let's move on to number 4. Okay, so you need to find your target budgeted sales, okay, and then find your break-even point, and then subtract that. Okay, subtract it. Okay, so let's see. So as I said, our break-even point is 360. So if we sell anything below 360, we have a loss. Okay, so our targeted sale. What is the targeted sale for this company? Oh, 450,000. That's right here. That's the total sales they want to sell. That's the targeted sale. 450,000. What's the break-even point? We already have a 360,000 right here. That's a break-even point for 360,000. So we subtract this minus that. That gives us 90,000. Looks at the target profit, isn't it? Good. So that means we are 90,000 away from having a loss, or 90,000 above the break-even point. Okay. So yeah, that's what I've explained here. Fall into that page. So this is how we calculate what we call the margin of safety in dollars. Okay. Now we were also asked to find the margin of safety in percentage. Okay. So in percentage, we need a margin of safety. We need a margin of safety in dollars, which is 90,000, and targeted sale, which is 450. So it's just the thing that flips around. Okay. We are just flipping the formula around. But instead of subtracting, we divide here. Okay. Here we subtracted, and in this case, we're going to divide. Okay. So that 90,000 divided by 450,000 gives us 20%. Okay. So we are 20%. In order to avoid loss, we need to sell at least 20% of our sales. We need to make 20% of our sales. So when your salesmen go out, you have to enforce them to sell at least 20%, else you have lost and your company will go to ditch. Okay. So number 5, we are almost done with this one. Okay, what is our number 5? It says, what is the company's CM ratio if sales increase by 50,000? Okay. Now, CM ratio is CM ratio. That's the percentage. Okay. And the percentage that we found was 60%. Okay. If nothing happens to variable costs, that means your percentage is going to stay the same. Your CM ratio will only change if your variable cost increases in price per unit or decreases in price per unit. But in this case, CM ratio is going to stay the same because nothing happens to variable cost. So our CM ratio will remain as 60%. Okay, 60%. So now let's go ahead and do that. Yep, that's what I explained. An increase or decrease in contribution margin will have the effect on have the same effect on net operating income. Okay, so what we need to do, we have been asked to find a net operating income. Okay, so another thing you also take note is contribution margin also. Okay, if sales increase and there's nothing happening to fixed expenses, the increase in contribution margin will be the same increase in net operating income or profit, or the decrease will be the same decrease in net operating income or profit. So let's go ahead and compare this. Okay, you ask yourself, what is the contribution margin? It's the same as 60%. Okay, so CM will stay the same. Okay. Now, what effect will that have on that 50,000? Okay, so that means if it's increasing by 50,000, let's say it's increasing by 50,000 units, then CM ratio, okay, contribution margin will be 60% of that. That is the increase, okay? Because every 1 unit we sell, contribution margin have 60% out of that. So if we are selling 50,000 more, we will have 60% of that. So this one multiplied by the 60%, and that gives us $30,000, okay? So we have a $30,000, that will be our increase, okay? And you can do it another way, like you want it. Okay, so you have your expected increase in sales at 50,000. And then what is your CM ratio? CM ratio is 60%. Okay, so you multiply that by this, and that gives you 30,000. So that is your expected sale. But if you want to do it in what we call contribution margin format, so you can see the numbers changing, I can also do that for you, so you can see. So what is our current sales? Our current sales is 450,000. Okay. So let's take 450,000. What is our variable cost? We have our variable cost at 180,000. Okay. 180,000. Oh, 180,000. Okay. And then we know our contribution margin will give us this. We were 270,000. Our fixed expense was 216,000. Okay. So our profit is this minus that. That give us 54,000. Okay. Remember, sales is always 100%. Okay. What's the percentage for this? That's 40%. So that means contribution margin is automatically 60%. Expected. We know sales is going to increase by 50,000. So this plus 50,000. That gives us 500,000. Okay. And the percentage of variable cost is 40%. That gives us this. Then we subtract these two, and contribution margin will be 300,000. Okay. And the fixed expense is going to stay the same. It doesn't change. Okay. And then our new profit will be this minus that. Okay, so what is the difference on profit? This minus that one, that's 30,000. So profit is increasing by 30,000. You can also do the difference here if you want, 50,000. And then we drag it all the way down, okay? And the contribution margin is 30,000. So the increase, because nothing happened to fixed variable expense, the increase is the same 60%. Let's go here 30,000. And because nothing happened to fixed expenses, the increase in contribution margin will be the same increase in net operating income. Great, makes sense? Good. Let's move on to the next one. Okay, here we need to find, it's still recording. Okay, we need to find what we call break even. And I told you that one of the most dominant things we will do in this test review is break even. So, and lo and behold, we are doing it. Okay, so we're going to find break even point, but in unit, it says either, but we're going to do in unit and in total sales. Okay, that's the break even point. Okay, so let's go ahead and I will reveal the formula for you to see quickly. So we will go ahead. Yeah. And we have already done something similar to this. Okay, so we're just repeating what we did in here. How we found this break even. We're just repeating the process. And since we have already done that, I will go a little faster. Okay, so what is our fixed expense? Right here, 214,720. Okay, 214,720. Okay, and then our unit CM. Okay, what is our unit CM? Okay, so here we have our selling price is 160 and our variable is 62.40. So that means our unit CM will be the difference. Okay, so we take 160 minus 62.40. Okay, so our unit CM is 97.60 because variable expenses plus contribution margin will give you total of the selling price per unit. Okay, so what we need to do is take this, divide by that, that gives us 2,200 units. So at the break-even point, we need to sell 2,200 units. Okay, that's the units. Okay, let's continue with CM ratio. And CM ratio is the same fixed expenses, but in this case, this time, we're going to divide by contribution margin ratio. Okay, good. So what is our fixed expense? It's going to be the same as that one. What is our contribution margin ratio? How do you find that? Okay, so your contribution margin ratio will be your unit contribution divided by the total sales. Okay, the selling per unit, which is 160. Okay, so we take this divided by 160. So our unit contribution margin is 60%. Okay, you see that? We take that, we take the selling, we take unit CM divided by the selling per unit, selling price per unit. So we divide those two, this one divided by that, and that gives us 352,000 in sales. Okay. So that is a break-even point for this exercise. That was very simple and straightforward. Okay. Now, let's move on to the next one. One, two, four. So in this exercise, okay, so in this exercise, we have to compute what we call, let's see what we're looking at. Okay, so it said determine overall break-even. Okay, break-even point again for the company. Okay, show your work. We're going to show your work, of course. Okay, so we know the formula to be the same, right? The formula to be fixed expenses divided by CM ratio. Okay, because this one is dollar. Okay, we're going to do dollar, so CM ratio. But in this case, we are going to do it for the whole company. And the company has two products. The company has product Q911 and this product which they call product JF3. Okay, so these two products, product Q911 and product. Imagine you are a salesman and you knock at the door and say, hey, I'm selling 911. Sorry, go away. I don't need emergency kit. But anyway, so yeah, we have these two products, Q911 and J. So in order to find the break-even point for the total company, we need to add these two products together because the company-wide. So we need to add them together in order to find our break-even for the whole company. If we were to find break-even for only this, then we're going to use only this. But because the total company, we need to add them together. So I've done what I call a schedule for you to see how that works. Okay, you can go ahead and just add them together, but let me do a schedule for you so you will see how this two works. Okay, so what is our selling? Our sales for 911? Okay, that's 15,000. The emergency kit and variable expenses 5,850. Okay, so what is our contribution margin in this case? You take this minus that gives us 9,150. Okay, now we stop here because we can't find net operating income for this. We need to find it for the total. Okay, so 1,100 for the next product, 11,000 actually, 11,000, and then variable cost is 5070. Okay, and then we just drag this one here and it compute the formula for us. 12,593. So what is the total? The total is going to add these two together. Okay, and you drag it down, compute this one too, and then you drag this one down. Okay, and then you have 15,000. Okay, let's subtract that one for you. Okay, great. What else do you need to do? You need to put your fixed expense there, and then your fixed expense is 13,980. Okay, 13,980. That's your fixed expense. So what is your net operating income? That contribution margin minus the fixed expense. So net operating income is 1,100. But you need to find the percentage for that. But we know sales is always 100% because, and in this case, we are finding for the whole company. So we are going to use the total. Okay. So the percentage is this one divided by that gives us 42%, and automatically this minus this will give us 58%. So the contribution margin for the whole company is 58%, and that is what we're going to use to find what we call our break-even. And to use 58% to find our break-even point. Okay, and that will be fixed expenses divided by unit CM. So we were computing this, so we will find the unit CM. Okay, so let's move ahead and reveal it. Okay, so what is our fixed expense? That's here, 13,980. So we just select that one. So what is our CM ratio? That's 58%. We select that one too. And then we divide this one by the 58%, and that gives us 24,103. So we need to sell this much. Okay, the 45 cents is very important. Okay, don't give it that away. We need to sell this much to get exactly 0 profit. Okay, so great. What is our next exercise we need to do? B said if the sales mix shift toward product K1 with no change in total sales, what will happen to break-even point? So as I said from the beginning, in this case, we are going to only focus on product 911. Okay, the emergency kit. We're only going to focus on that one. So to focus on that one, let's find what we call the contribution margin percentage for that one alone. Okay, so we know we have the sales for that, and then we have for that. So we're going to subtract, and that is our that is our contribution margin. Okay, and we only need our contribution margin ratio. So we take this divided by that, and that is 61%. You can do those two, but the only thing we need here is our contribution margin ratio, which is the 61%. Okay, that's what we need to find our break-even point. Okay, so let's move ahead and find our break-even point using the formula, and the formula is fixed expenses divided by unit CM ratio. Okay, So in this case, we are only focusing on kill product, okay? And remember, fixed expense doesn't change. Fixed expense. Whether you sell one product, you sell 10 products, your fixed expense is the same. So whether for the whole company or only for the product, our fixed expense is going to stay the same. So that is going to stay 13,980. Okay. What is our unit CM for this product alone is 61%. Okay, so we divide those two, this divided by that, and that gives us 22,980. Okay, 22,980. Great. Now, he asked us, or we were asked, what will happen to break-even point for the company? Explain. Great. And I'm going to tell you this. Okay, I'm going to make an analogy, so you will see. First, pay attention to this. Okay, if contribution margin increases with no effect in fixed expense, fixed expense doesn't change, break-even decreases. If contribution margin decreases with no effect in fixed, if fixed expense nothing happens to it, break-even is going to increase. Okay, so contribution margin has an inverse relationship with break-even point if nothing is happening to fixed expenses. And we will compare this with to an airplane or aircraft. Okay, and one of my smartest accounting teachers taught me this, Brother McDougall, and he said this when we were doing a cash flow. Okay, but I think this can also be related to contribution margin. You see an aeroplane. If aeroplane is going, it has two wings. One wing goes up and the other wings goes down. Okay, if the left wing goes up, the right wings go down. Okay, so contribution margin and break-even point is like an aeroplane. It goes up and down. Okay, so one wing goes up and the other wings go down. That's how aeroplane flies. Okay, if the right wing goes up, the left wing goes down. If the left wing goes up, the right wing goes down. Okay, so that has an inverse relationship. Up, contribution margin goes up, and then break-even goes down. Okay, but here, if fixed expenses, okay, increases with no effect to contribution margin, break-even increases. If fixed expense decreases with no effect in contribution margin, break-even decreases. So you need to pay attention to this. This has a positive relationship. Fixed expense is like a bird. When a bird is flying, one wing goes up, the other wing also goes up. If one wing comes down, the other wing also comes down. So it's up and down. They are going up and down the same time. But with the other one, which is the aeroplane, they go opposite way. They go opposite way. Okay. So that's how you need to pay attention with that. So in this question, you ask yourself, what is happening? Our previous contribution margin ratio is 58%. And when we use this one, it's 61%. Is contribution margin increasing? Yes, it's increasing. So what will happen to break-even point? Break-even point will decrease because it has an inverse relationship, like an aeroplane wings. One wing goes up, the other wing comes down. Okay, so that is what we have here. Did you see the pattern? This one, and then it decreases. Okay, let's make a scenario. Let's imagine we have the same fixed expenses, but in this case, contribution margin is going to decrease. Let's decrease it and see what will happen. Let's say we have contribution margin of 40%. Okay, my analogy is that because it is decreasing with no effect in fixed expense, break-even will go up. Let's see if it will go up. Great, it went up by 34,000 compared to this. Okay, so that went up. Okay, so that's the analogy. Pay attention to this. Contribution margin has an inverse relationship with break-even point if nothing happens to fixed expenses. So that is how you're going to answer it. Okay, let's move on to the next one. What do we have here in the next one? So here, you're going to use do same sales mix and break-even point analogy and those things. Okay. So one, it says prepare a contribution format in both dollar and percentage. Okay, for each product unit. Okay. So in this case, we're going to make what we call an income statement. Okay, we're going to do an income statement. But you remember, this company has two products. Okay, product one and product two. So just like we did in the previous one, that we add these two products together, we are going to do the same by adding them together. So I already have the format, let me reveal it. So we go ahead and go. Okay. So we have two products. Okay, we can call division, or we can choose to call it product. Okay, so we have two products here. So we're going to find the product for Hawaiian Fantasy and the product for Titan Joy. Oh, that brings joy to my soul. So let's move ahead. Let's go ahead and do that. So what is our sales? Okay, I'm going to do sales. Okay, what is our sales amount for Hawaii? We don't know yet. Okay, or do we? No, we don't know, but we know the per unit. Okay, so per unit is 15. We have 15 there. You put in the information you know. And then we have what we call variable expenses 9. Okay, so automatically contribution margin will be this much on that. I give us 6. Okay, that's our contribution margin. Okay, now in order to know the total amount, you need to know how much unit was sold. Okay, so I'm going to say the number of units sold was 20,000 here. So let's put, I'm going to put 20,000, and I'm going to make a unit sold. Okay, so if we sell 20,000 units and one unit is $15, so we multiply by 20,000 units. Okay, that gives us 300,000. Great. And the variable expense is also going to be 9 multiplied by the 20,000 units. And then now our contribution margin for that product alone will give us 120,000. Okay, so now we have found this. Let's look at the percentage. Okay, this one is always 100%. And then this divided by that will give us 60%. So automatically we know this minus this will give us 40%. So we had done with Hawaii. Okay, let's move on and go to Tahitian. Tahitian, we have 100 selling and 20 variable. Okay, so we have 100 and then 20. So we know contribution margin will be this minus that. That gives us 80%. Okay, and then sales is always 100%. Okay, so we can divide that by this, give us 20%. So automatically this minus that is 80%. Remember, you can use the total, or you can decide to use that to find a percentage. It's going to give you the same thing. Okay. Now we have the percentages, but how many units did we sell for Tahitian? It says we sold 5,000 units right here, 5,000 units. Okay, so we're going to put 5,000 units. So this is what we call, you let them know what's happening. Okay, so in order to do this, to find the total, we take the 100, we multiply by the 5,000 units, that gives us 500,000. Then we take this unit 2, multiply by 5,000 units, that gives us 500,000. Okay, there are two ways you can do it. You can take the percentage, multiply by this, that gives you 400,000. Or you can do this one, multiply by this, that gives you the same 400,000. Or you can take this minus this, that gives you the same 400,000. So there are some ways that you can do it, you get the same number. Okay, now we need to find the total. Okay, what is the total for adding these two together? Adding the product, the total for amount for Hawaiian and then amount for Tahitian together. So we'll take this, we'll take the amount plus this amount, okay, together. That gives us 800,000. Okay, and if you bring this one down, it will do the rest. Okay, it will just do the same thing for you. Okay, and then there are ways you can do this. You can just take this minus that, that gives you 520,000. Okay, or you can get rid of it and then bring this cursor down. That will still give you 520,000. So whatever ways you choose to do. Okay, now the fixed expenses for the entire company. So we're not going to use the fixed expenses here. We're only going to use it for the entire company here, just like we did here. Fixed expense only goes to for the entire company. So what is our fixed expense? Let's look for fixed expense. 475,800 right here, fixed expenses. So 475,800, that is our fixed expense. So our net operating income will be contribution margin minus fixed expense. Okay, so then we have our fixed expense, net operating income as 44,200, but we need to find the percentage for this. Okay, sales is always 100%. Now our percentage is going to change. Remember when we did the previous one, the percentage for the total changes when we did only for the product. Okay, so 100%, and our total percentage will be this divided by that. That gives us 35%. So automatically we know it's going to be 65% for contribution margin. So our contribution margin is 65%. So that is how you do it. Okay, this is the schedule. Okay, we have the Hawaiian product, we have the Tahitian product, and then we have the company-wide this, and then percentage changes to 65%. Okay, on contribution margin. Okay. Let's go to the second exercise. What do they want us to do? 1B says compute the break-even point in dollars for the company as a whole. Aha. A margin of safety in dollars. Okay. So break-even point for the company as a whole. That means we're not going to use this one or that one. We're going to use this. The contribution margin for the company as a whole. The 65% is what we're going to use. Okay. So let me reveal it quickly and let's look at them. Okay. So what is your fixed expense? The fixed expense is this one, 475,000, divided by the contribution margin ratio for the whole company, 65%. Okay, so we divide that one by this, and that gives us 732,000 sales. So we need to sell 732,000 to have a break-even point. Okay. Now, computing margin of safety. Okay, that is the number of sales above break-even point, and that one is always targeted sales minus break even. Okay, so let me reveal the formula so you can see. So what is our targeted sale for the total company? As 800,000, because those two products together will give us 800,000. Okay, what is our break even point? We already have it here, 732,000. That's a break even point. So our margin of safety, we will just need to subtract to get our margin of safety. This one minus that, and then we have 68,000. So that is our margin of safety. Okay, we are $68,000 above our break-even point. Okay, great. And the next one, they want us to compute margin of safety in percentage. I think that's what it is, in percentage. Yep. And so in percentage, we need to find our margin of safety and then our total budgeted sales, and we just divide that one. Okay. So what we do is, I'm going to revert the formula. So what is our margin of safety in dollars? We already have it here, 68,000. And what is our targeted sales? So we just flip the formula. Wow. Okay, so that is 800,000. Okay, great. You divide those by 2, that should give us about 8.5%. Okay, yep. So we have 8.5% for our margin of safety. Okay, so we need to sell at least 8.5% to be away from our break-even point. Great. I'm moving a little bit faster here because we need to finish all these. Okay. Number 2, it says the company has developed a new product to be called Samoan Delight. Wow, that's going to sound fresh. Okay, assume the company could sell 10,000 units. Okay, so here you pay attention to the information you're receiving here. So the company will sell 10,000 units just for the Samoa, not for the total. Okay, and at $45 each. And the variable cost will be 36. So we're going to use this information to answer the rest, the following. Okay. What I will do, that'll be, okay. So, so I'm going to, I already have the formatting. Okay, so I'm going to reveal it. Reveal. Great. Now there we go. Okay. Because we already have these ones, I'm just going to copy and paste them, okay, and put them here, okay, so we don't have to do them again. So I'm going to copy and paste all these. Just put in the number. Okay, great. So we already have this, but we adding just another product, okay, that's called Samoan Delight, okay. So what is Samoan Delight? It says we are selling 10,000 units and each unit is sold at 45 and variable is 36. So, you know, we have here $45 and then 36 is variable. So contribution margin will be this $9, okay? And here it's always 100%, okay? And then we divide that one by that gives us 80%. Automatically contribution margin will give us 20%. Great, does that make sense? Let me know if I'm going faster. You can pause it and rewatch that side. We're just going faster because we have to beat time. Okay, so when we go here, how many units are we saying? I believe 10,000. Yep, 10,000 units. So we just going to need okay, so we're selling 10,000 units. Okay, 10,000 units will be sold for Samoa. Okay, so in order to find the total, we take 45,000 multiplied by 10,000 units. That gives us 450,000. Then we take 36 multiplied by 10,000 units, or you can do 80% multiplied by 450,000. That's still going to give you 360,000. Whatever, however you want to do it. Okay, this percentage multiplied by that, that's going to be 90,000. Now we're going to add them together as a whole company. So the company used to have only this, but they are adding another one. Okay, so what will be their total? So we take the total, the amount plus this one amount plus that one. Okay, that gives us 12. That okay, and then if we drag it down, that will compute it for 264,000. Okay, and then we can use to do this minus that to find our contribution margin. What is our fixed expenses? Okay, our fixed expenses did not change. It's going to stay the same. Okay, so we're going to select fixed expenses from here, 475,800. Okay, and then our new contribution margin for the entire company will be this one. That's $134,200. Okay, does that make sense? Yep, that should make sense. So 100%, this 100%, we're going to find contribution variable percentage for the entire company that give you 51%. So automatically this minus that will give us 49%. Great. Does that make sense? Great. Good. So that is how you do it. Okay, you just add in one product to it. Okay. Now let's go to our next question. Did they ask any other question? Seems like it. Okay, 2B. Compute the break-even point in dollars and unit for and safety for the percentage. Okay. So we're doing this one too for the entire company on 2B. Okay. So I'm going to reveal all the formula and let's just find them. Okay. So what is our contribution of fixed expenses? Okay. Our fixed expenses did not change. It did not change. That is that one over there. And what is our CM ratio for the entire company? That is 49%. Okay. It used to be 65%, but because we add another product, the contribution margin now is 49%. So in order to find our break even, we divide that one by that, and that gives a 97,500 sales. Okay. Our computing margin of safety. What is our targeted sales for this new company? Our new product, that is 1250. What is our new break-even point? That is that one, and then we divide those two, and that gives us. This should be a percentage. Minus 50. So we're going to subtract this minus that, and that gives us 275,000. Okay. So in this case, we're going to flip the formula in this second one. I'm going a little bit faster. Margin of safety in dollars is 375,000, and what's our targeted sale is this one. Okay, this is where we divide. We take this and we divide by that. That should be around 22%. Yep, 22%. Okay, so we have the 20% as a margin of safety. Okay, does that make sense? Great. So you can feel free and pause the video and redo it or rewatch it. Okay, we're just trying to beat time right here. Okay, So let's move ahead and go to what we call question 3. So question 3, the president of the company examines your figures and says, there is something strange here. Our fixed expenses haven't changed and you show greater total contribution margin if we add the new product, but you also show a break-even point going up. Oh, with greater contribution margin, the break-even point should go down, not up. Well, so the president is trying to tell you what to do. Okay, challenging you now. You have to defend yourself. Why is it that sales is going up, but break-even point is going down? You have made a mistake. Oh, okay, great. So how do we explain this to this company, this manager? Okay. Okay, now, how do we explain that? How do we compare these two? Okay. Well, we know although sales increase, okay, sales is increasing, and our break even, what we call contribution margin is also increasing to 610 from 1230 to 610, but the percentage compared to this, okay, is going down. Okay, so the percent, because contribution margin percentage is going down, break even point to go up. Okay, remember the analogy, up and down. Okay, they're like a plane. Okay, one wing goes up, the other wing goes down. So tell the manager, okay, he's not going to fire you for this. Tell the manager that although sales increased, okay, and contribution margin also increased, the percentage of contribution margin out of the new sales is going down. So because it's going down, our break-even point also went up, as because it has an inverse relationship. Like I explained to you in my previous video, it has an inverse relationship. Okay, great. So that's how you answer that question. You can answer it in your own words, but you can pause the video and watch my answer, how I explained it. Break-even point went up because and what caused break-even total contribution margin to went down. Yes. Okay. So you can pause the video and watch it with my explanation. So, and at this point, we will move on to the next video. We only have 3 more, and then we'll be done. Okay. What are we trying to find here? Dun, 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 dun. So they want us to find fixed expenses for the company as a whole at 120,000. The break-even point will be dash. Okay. Now, this is similar to what we did in the previous ones, okay? But I'm going to do it in another way, okay? And I hope that that will help you, okay? Find it quicker or easier, okay? Okay. So what is our total sales? Okay. So we're finding that break even for these 2 companies. So we have to add these 2 companies together. Okay. So what is our total sales? That is this 100 plus this 50. So that should be 150. Okay. But we're going to do 100,000 plus 50,000. Okay. That is 150,000. Okay. What is our total contribution margin? Do we do the total contribution margin? So 70% of 100,000 and 40% of 50,000. So this is how you're going to do that. So 0.7 times 100,000. Okay, plus you open parentheses again, 0.4, 40% times 50,000. Okay, you close parentheses. So that gives you total contribution margin should be 90,000. Okay, now what is our contribution margin ratio? This one divided by that is 60%. So our CM ratio is 60%. I didn't do the table like we did in the previous one because we need to move on faster than we are now. Okay, so now what is our fixed cost? Fixed expenses is 120,000. On the test, you can use this formula and then you go straight up. Okay, you don't have to waste so much time. What is our CM ratio? Is 60%. Okay, so we divide that by that. This one divided by this. So 200,000 is our break-even point. The answer is A. So that is our A, 200,000. Okay, let's move on to the next one. Okay, in this case, sales mix is shifting. Okay, so sales makes a shifting toward product X, okay, and this is our product X, okay, unchanged, and fixed expense remains unchanged. Okay, what will happen? Good, that's what I said. Okay, if sales mix is focusing on product X, okay, what is our product X per unit CM ratio? Is 70%. Compare it with the total one, 60%. So if 60% is 200,000 and contribution margin is increasing to 70,000, what will happen to break even? Will break even increase or decrease? Remember, contribution margin increases and break even decreases. So that means the answer is B, decreases. Okay, inverse relationship, remember that always. Inverse relationship, contribution margin to break even. Okay, good. So that is your answer. Your answer is total contribution margin is 60%, but product is 70%. It's increasing, so break even will decrease. B. 70. Let's move on to question 70, and we have, I think, one more or two more, and then we will be done. Okay, we are almost there. Okay, so now what do we need to find here? The break-even in $6 for the expected sales mix is closest to, okay, so we need to find the break-even point for this one again. Okay, so I will reveal what we need to do here. Okay, so we have two products, okay? What is the selling? We have standard and delight, okay? What is the selling price for standard? Okay, it's 150, but we are selling 600 units. Okay, so we multiply that by 150 times 600 units. Okay, so 90, that's 150 times 600 units. Okay, 600 units. That's 90,000. Okay, and then we have, so what we can do is we can have our unit here, so 600 units. Okay, what is our variable cost? So variable cost is, we have two variable costs here. If you notice that, okay, we have this 120 and we have this 16. Those are the two variable costs. Okay, so those two together is $136. Okay, so our variable cost for standard will be 136 multiplied by 600 units. So 81, that one. Okay, so we just take this minus that gives us 8,400. Okay, let's go to deluxe. What is our selling price? Our selling price is $165 multiplied by 1,200 units. Okay, because we have here says 1,200 units we're selling for deluxe. Okay, variable expenses. So we add this 126 plus 13 together. Okay, that gives us 139. Okay, so the variable expenses is 139 multiplied by 1,200 units. Okay, that gives 166,800. And then our contribution margin for that one will be 31,200. Great. Now let's find the total. We add these two together. Okay, this plus that, 288, and then we just drag it and then it compute what we need for us. Okay, so we have 39,600 as contribution margin for the whole company. What is our fixed expense? Our fixed expense is 15,000 right here. So 15,000. So what is our net operating income for the entire company? That will give us 30. 9,600. I didn't. This one minus that. Okay. This should be 15,000. Okay. Yep. 15,000. That looks very small. I realize there's something wrong. So 15,000. So net operating income, you can tell I'm getting tired. Net operating income is 24,600 for the entire company, but we need to find the percentage. Okay, this one is always 100%. Okay, what the percentage for variable cost divided by that? That's 86%. And then what is the percentage for this one too divided by that? Oops. Okay, if this one is 100 minus that gives us 14%. So we know this is 14%. Contribution margin for the whole company is 14%. And we are asked to find the what do we call the break-even point in sales. Okay, and we know break-even point is fixed expenses divided by unit CM. Okay, and in this case we use the unit CM ratio as this one, 14%. Okay, so let's reveal it and see what we have here. So our fixed expense is 15,000. We put it there. What is our unit CM ratio is 14%. So we divide those two. This divided by that. That gives us 10,909. Which one is the closest? That is C. Okay, 10,901. Right. So C is the answer because that one is the closest. Okay. Let's move on to 189. Okay. What is our 189? What are we trying to find here, my friends? Okay, so 189, we have been asked a couple of questions. Okay, fixed expenses is done. So we are going to use the same formatting we used in the previous one, okay? Similar formatting in order to find this, okay? So the management is considering using a new product that will increase the unit variable cost by $3 since the new product will improve the company's marketing manager, okay, 30 unit more, okay. So this is what we're going to reveal. We're going to find what we have now and we're going to compare it with the expected one and then we find the difference, okay. So what do we have now from this exercise? We have our current one as 190 times 7,000, okay, 7,000 units. So we have this 190 selling price multiplied by 7,000 units. That gives us 1330, okay. What is our variable cost for our current one? That's 114, okay. 114 multiplied by 7,000 units. That gives us 798. So we will have contribution margin of 532. What's our fixed expense? Fixed expense is 387 right here. Okay, so 387,000. And then we do this minus that. That gives us 145,000 as net operating income. But we are expecting, what are we expecting? We are expecting now to sell 300 more, okay? 300 units more will increase. So it says here, sales will increase by 300 units. Okay, so 7,000 plus 300 is 7,300. Okay, so that's how I got that. Okay, and will the selling price change? No, the selling price isn't changing. Okay, only variable cost is going to change. Selling price is not changing, but variable cost is going to change. Okay, variable cost will increase by 3%. So let's see, the selling price is going to stay the same as 190. So we have 190 multiplied by 37, that get 387. And our variable expense, okay, we know our variable expense was 114, but it's increasing by 3, so it's going to be 117 now, okay? You know the math, 114 plus 3, 117, okay? I did that for you to see. So 117 multiplied by 7,300. That's what it's going to be now. Okay, so we just find this, or we can just drag it over. Okay, so that is our one. That's the one, and that's the one. Okay, so our new one will be 145,900. Okay, that's a new. So what is the difference? You want to find the difference. So you take the increase minus the current. Okay, take the expected one minus the current one, and that gives you $900. Or you can do this one too minus that, and the same. And as I explained in the previous video, if there's an increase, okay, an increase or decrease in contribution margin without any effect on fixed expense will have the same effect on net operating income, which is our profit, okay, because fixed expense didn't change, and the increase here will be the same as the increase on the profit, okay. And okay, so you can do that by, we have our 76 multiplied by 7,000. Okay, and then 73 multiplied by 7,300. Okay, now what is the difference? the expected one minus this one, that will still give you the $900. Okay, so the current CM and then the current CM and then the expected CM, and then that will still give you the 20. So that is all for this one. So let's move on to the last but one. Yay, we are almost done. Okay. So last but one, what is happening here? Okay, so we need to find the target profit again. Okay, so now our break-even point should be 0. Okay, if our break-even point should be 0, our target profit, what would that be? So the answer is right there. Okay, so but I'm going to show you how to do that to get the answer. Okay, so this is how you do it to get the answer. But let's go back and see. So what is our target profit? Our target profit, we want to have a target profit of 5,400. So we take our 5,400. Okay, what is our fixed expense? Okay, our fixed expense is 604,800. So 604,800. Okay, so now the total this plus that will give you 655,200. Okay, now what is the unit percentage? Okay, unit percentage, unit CM percentage, I think would give me 63%. So this one is very straightforward, 63%. Okay. So we take this and then we divide that by that, and that gives you 10,400. Okay. So the answer is 10,400 right here, 1,040,000 right here, as we said. Okay. So that is your sales target profit and sales in units. Okay. So with this one, we have been asked to compute them using the equation method, okay? And it's really hard to write equation method on Excel. So I'm going to make another video. So watch my next video. I'm going to focus on this one specifically using a whiteboard, okay? So the equation method will simply be, see. This is how you find the equation method, okay? When I start to do it on a whiteboard, okay? So I'm going to make, as I said, I'm going to make a separate video and show you how to do it, okay? But to do this, we will have our contribution margin minus fixed expense should equal to 0. That's our break-even point, okay? That's what you're going to have. But when you're having the units, okay, your contribution margin should be unit CM multiplied by the number of product you want to sell as the quantity. Okay, so CM is equal to this one. Okay, that's how you do the equation method. Okay, so I'm going to do a separate video and focus specifically on this exercise. Okay, because I have to use whiteboard and not Excel. Okay, so there are several ways of doing accounting, and whatever way you choose to do, keep practicing and you will get better at this. Good luck on your test.